Wanted to go over a challenging DSCR scenario with you so you can see the numbers, hear the numbers, and understand the importance of picking the right property value and the right rental income. Real quick, I'm Jason. I own Jakin Capital. We do real estate investment financing for investors just like you. So this particular scenario, the borrower bought the property with a bridge loan about a year and a half ago, and she put 15% down. That was a product we offered at the time. We still do in some cases. The current property value is $740,000, and she brings in $5,100 a month. The market rent, however, is only $3,700 a month, and that's proven on a 1007 rent schedule. So with a property value being $740,000 and a rental income market rent of $3,700 a month, we have to go off that because we either go off the leased income or the rent income, whichever's lower. Her debt service coverage ratio is going to be below 1, and that should be obvious if you kind of take the 1% rule as a thumb rule. Now in this particular market in Texas, her taxes are also $11,000 a month. Her insurance is, $11,000 a year. Her insurance is $1,800 a year, and she has an HOA of $600 a year. We quoted her at 70 LTV on the refinance because we don't have a DSCR of greater than 1. Her DSCR is actually 0.77. With a 7.75 interest rate on 30-year fixed, she has decent credit. Her monthly payment is going to be $37.11 a month, and with all her expenses in, her monthly in payment including expenses is going to be $48.27. So she's bringing in $5,100, $48.27 is her payment, including PITI. She's going to net $300 a month. Those aren't the greatest numbers on a DSCR loan, but when you don't get your rents right with your property value, and it's just a challenge with these higher property values, you're going to run into issues where you need to put a lot down or have a lot of equity in the deal to make the numbers work. She's moving forward with this. It's not the most attractive loan, but that's one of the challenges with DSCR is that if your numbers aren't locked in for the property, you're going to have problems getting the debt service numbers above 1. So a good rule of thumb is to take the property value, multiply it by 1%, and that is roughly what your rental income should be. Obviously, there are exceptions, but if you're not near that rule, you are going to have a hard time meeting the DSCR. If you have any other questions about this is a challenging scenario just because the numbers aren't great. We can go over it. We have a calculator on our website that you can use for free. Just leave a comment and I will give you the link to go use that so you can play with the numbers yourself.